A Goldilocks non-farms print takes the US stock market to new all-time highs. However, the breadth and volatility indicators show worrying signs, and a weak Chinese economy poses risks to all global assets. All this and more in this week's Macro Insight. Welcome back to Macro Insight, everyone. Today is the 6th of July, and let's take a look at these markets. Welcome to any new subscribers, any free trialers. Great to have you on board, and let's have a look. So, what's been going on? The last week was all about non-farms, really, right? We had flagged that was the main event of the week, and obviously that came in. And the non-farms print, everyone's calling it the Goldilocks print, right? It was slightly ahead of headline consensus, came in at 850K payrolls added versus an expectation of 720K. But then if you look at some of the internals of the report, where those jobs were coming back, and also the fact that the unemployment rate was a bit higher, that kind of left enough room for improvement such that, you know, the Fed isn't under any pressure to bring forward tapering talk immediately, right? So that was kind of how the market interpreted it. And the S&P kind of took its cue, as it loves to do, to break to the upside and got to around the 43.50 level. So if we bring up the charts, you can see here. So we were seeing some momentum divergences before the break to the upside. And that's usually, like I say, when you get markets going higher, but the momentum's kind of signaling a bit lower. But that doesn't mean it's always a foolproof indicator, those divergences, right? So we obviously got the news that the market was looking for, that we are seeing an improvement in the economy or in the labor market. And we saw the market break, okay? And then obviously into the holidays, you also get that as well. When you have a holiday period, you often, you know, more often than not, you get a market that kind of drifts higher, right? If you don't give it any terrible news. Now, you know, I had been thinking if the number was a little bit too good, if we were like above 1 million, there was a risk of good news being bad news, but that's definitely not how things played out, right? Now, something obviously that I look at a lot is volatility. So if we look at the VIX, normally when the market breaks to the upside, you would see volatility go down. But I've been saying that, you know, vol seems to be finding a bit of a base around this 15 level. And particularly on Friday, as we broke higher, we actually saw the VIX trade up. So it reached lows sort of probably midweek. And then it actually traded back up as the market rallied and took out new highs. Okay, so what does that signal? It signals that maybe the street positioning in volatility isn't quite as long as we thought it was. And as we're rallying, maybe that positioning is going away a little bit. And this type of, what you often see in this type of spot vol correlation is a potential reversal signal. So, you know, we saw something similar happen in September last year where the market was rallying. And again, it was being driven by technology stocks. VIX was actually stable to going a bit higher with the market. And then we ended up having a sharp reversal of around 10 to 15% last year in September. Yeah. So, you know, not a foolproof indicator, but something, you know, if the VIX does stay bid as we approach, let's say we keep going higher, we get to 4,400 and the VIX stays high, well, not high, but it doesn't go any lower. Let's say it holds that 15 level. Then I would be careful of a swift reversal, basically. You don't want to get caught out by that. Now, one way to manage that is to say, well, if you've been long the market and you think there's this risk of a swift reversal, then stock replacement strategies are quite a nice way to play that, right? So when volatility has come down a lot, you've owned the market, you don't know when the top is going to come, so you want to participate, but you are aware there's a fair amount of short-term downside if this market reverses. Maybe as far as 4,000 we could even get to, then switching some of your longs into 3 to 6 month calls is a sensible strategy given where implied vol levels are. Okay, that's called stock replacement. And then what else, if we take a step back and look at, how bullish this year has been so far, I think this is quite an interesting metric. So we've got first half of 2021 inflows into global equities have been the largest on record. Okay, so that's Bank of America doing the numbers. They're saying that if we get the same again in the second half of this year, then the inflows this year would be more than the last 20 years of inflows put together, which is a insane number, right? So clearly, this year has been bullish for equities. There's been a lot of reasons to be owning equities above other asset classes, but looking at those numbers, it's a pretty extreme inflow. And if you break down those inflows, the second chart on the right shows you, if you break that into active and passive, you see that primarily the inflows, whilst there was a fair amount of active at the start of the year, that's kind of petered down to nothing, whereas passive is still very much there. So the bulk of the inflows over the last couple of months has been coming in from the passive side, which we know, right? That wall of passive money, as Mike Green talks about a lot, that is become a big driver of what's making this market rally, and why tech stocks, just the mega cap techs that are such large weightings, they just keep getting bought, doesn't matter what price, right? So, interesting to kind of see that in the data basically, right? And explain what's going on a little bit. We've got another slightly concerning sign is the lack of breadth in the market, okay? So if you look at the graph that someone put out recently on this, number of companies that are above their 50-day moving average, the percentage of companies on the New York Stock Exchange that are above their 50-day moving average. So whilst we're making new highs in the S&P and the NASDAQ, that metric is rolling over, which is telling you that the leadership in this market is coming from fewer and fewer names. And if you look at the charts of a lot, 50% of stocks in the market, they're below their 50-day moving average. Okay, so when you see breadth roll over like that, often that signals that the market has a pause or has a correction coming, basically, right? Again, not foolproof, but something that may be making you a little bit more cautious that this rally is usually a rally is much more healthy if it's broad-based. This is definitely not a broad-based rally. Okay. Now, whilst all these signs are concerning, what is the bond market saying to us? Well, yields continue to go and are pretty much at their lows, right? Let's have a look. Share the. We could go back here. If we go to 10-year yields, seems to be everyone's favorite one. That is at the local lows down here at 141. So what is that telling us? Probably signaling to us that inflation concerns have abated massively. Okay. And if we do continue to see growth improve on a reopening and inflation has peaked, then that is pretty much the definition of Goldilocks, right? Where generally that environment where we do have growth, but we don't have rip-roaring inflation, that's kind of the optimal conditions for risk assets generally. And I think that is why, equities are doing what they're doing, because that is kind of what the market is pricing right now. Okay. And also credit markets, right? If you look at some of these credit ETFs like HYG, bulletproof. Okay. It's at its highs, LQD, pretty damn close to its highs, right? So usually, if the market was concerned about tightening policy and rates going higher, you would see an impact in the credit market. Yeah. But you're not seeing that. So, these are the things, these are the counteracting things to the kind of, what's making people cautious is like, well, I'm not seeing any trouble in the credit market. So then, let's let this Goldilocks scenario run. No need to take any action. Okay. And you've got Q2 earnings obviously kicking off, which may be a positive catalyst as generally companies do beat their earnings, and, remains to be seen what's priced in again. Like we're going to have to look at the price action if the banks come in with better earnings and things like that, how the banks trade. Last time round, the banks beat earnings quite a lot, but the market, but it was like loan loss reserves that were being released that were a big driver. You're looking at the loan books, they weren't really lending, the lending growth wasn't there. And so it wasn't as convincing post earnings. And so the stocks didn't really need to rally that much post earnings. Okay, so we'll be looking out for that again with the banks. Yeah. But then even if they beat on Q2, Q3 is likely to be much more challenging. So we may find this earnings season we get away with it, but next earnings season is going to be much harder to kind of beat, you would think. Okay. On the credit market theme, I do worry that the credit market is a bit distorted these days. You know, with QE and what's been going on, can we take the credit market as much of a signal anymore? I'm not sure we can, right? And so the people who are saying, oh, the credit market hasn't budged, so that means the world's okay, I'd take that with a pinch of salt. Personally, it's hard nowadays to find where the signal is because the whole market is quite distorted with the amount of liquidity out there. But whereas the credit market might have been a strong signal back in 2000 and 2008, I don't really believe it to be anymore because I think it's way too dominated by QE. And so I'm kind of ignoring what the credit market's saying, and I'm still getting relatively cautious about things with the market up here. And, you know, you look at what the bond market's doing, the treasury bond market. Well, if you think there's a signal in that, then basically that is saying that we're probably going to see weaker growth and inflation. Okay. And then if we were to see that, certainly going into Q3, Q4, then, you know, we may go into a market regime that is not necessarily Goldilocks, but is more deflationary. And that is likely going to lead to some more meaningful correction in equities of the order of magnitude of 10 to 15%, right? And that's really the risk here, right? That the rate of change on everything is going in the wrong direction as we go later into Q3 and we get closer to, say, Jackson Hole or whatever it may be. And it's going to be hard for growth to be, you know, it's going to be hard for growth to keep beating. Inflation's peaked. Fiscal policy is going to struggle to deliver on expectations. All of this support, life support the economy's been on starts running out. And it's like, where's the marginal buyer for risk, basically, right? So that's kind of the worry. At the moment, it seems like the market's bulletproof and doesn't want to roll over. But it also seems a bit inevitable over coming months that it's going to be struggling and it's becoming more and more priced. And on that note about it becoming more and more priced, I mean, Goldman's strategist, what's his name? I forget his name, but there's a chart from him and his price target for this year was 4,300 on the S&P. We're already there, we're through it. And normally these strategists revise their prices up when they get achieved within 6 months. And this guy's not budging. He's saying, right, there's no upside for the S&P for the next 6 months, right? So he's looking at earnings, he's looking at rates forecasts, looking at where valuations are versus forward PE multiples and stuff, and saying, yeah, I don't see any upside in the S&P for 6 months. Now he still sees the S&P higher next year, an upside towards 4,600, but it just seems like the market's done a little too much too quick, in his opinion. Yeah. In terms of what's driven the squeeze recently, well, we know the tech sector, right, has been flying. So if we bring up the NASDAQ chart, NASDAQ's been the one, especially, that has carried us higher in the S&P. And why has the NASDAQ been so, you know, bulletproof or been so strong? Well, obviously the rates move was a big one. So when the long end of the rates curve does something like this, or it's probably even better showing it on here, that move down, that flattening where 30-year yields dropped dramatically relative to 5-year, that was the impetus for the tech sector. So you had all the growth stocks rally like crazy. And, you know, also, so that's, you can see why they rallied, but probably the reason they rallied so much is because everyone was underweight. So there's a lot of people underweight tech and long value sectors, such as energy, financials, cyclicals. And that trade has basically been a pain trade, right? So there's been a bit of a squeeze in tech stocks where people got caught out being short them. They've been forced back into those. Hedge funds have clearly had to address that and been forced back into tech stocks and are now less short, if not even long again. And unless the reflation narrative now reemerges, now that short squeeze in tech looks like it's kind of done, unless the reflation narrative reemerges and some of those other sectors can kind of take the baton back from tech, then the market may be looking a bit vulnerable here, right? Given that it's been such a narrow rally and it's just been led by tech, okay? And then, so I would say if you are of that view and you are a bit more cautious, then stock replacement we already mentioned, but given the relative steepness of skew and the fact that the Fed, so you've got steep skew and you've got the fact that the Fed put is probably still alive to some extent. So if we were to get a 20% drawdown, you would get, the Fed saying what they needed to say very, very quickly. The idea of tapering would just be off the table for another year, let's say. So then put spread hedges are probably going to be the most attractive for people who don't want to switch all their equity exposure into calls via stock replacement. If you want to add some hedges to your book, then put spreads take advantage of that relatively low vol and relatively high skew that we found ourselves in if you're looking to protect downside, basically. Yeah. And then in the report, I've got a white paper to the skew index that I've been mentioning over the last few weeks. That kind of goes into how they calculate that skew index. It's not quite as straightforward as just taking the vol differential between the 25 delta puts and calls, which is like what the vol guys do. Like, it's a bit more involved how they can calculate that, but in general, it's kind of telling you the same message, basically. Yeah. Okay, so that's kind of a bit of a long story on the US and the equity market. What's been going on in Europe, on the other hand? Europe's not really participated in this last leg of the rally, right? So you can see we had our correction kick off on the FOMC hawkish pivot, and Europe's not really got any legs on the rally. So they don't really have the same tech weighting. So it's a bit more cyclical, the European broader indices. And also you've had a few things like German factory orders missed expectations today. You've had the Delta variant, popping up all over Europe, making people a bit kind of nervous around reopening, around summer travel that Southern Europe relies on quite a lot. So, these are all things that maybe sort of put a dampener on European growth. And there were some revised expectations on that. We'll see what happens with the Delta variant. It seems like deaths and hospitalizations are not really ticking up. So it doesn't seem like we're necessarily going to need to go back to lockdowns. And if you take UK as the leading indicator here, given that, we had the Delta variant first, and well, not first, obviously, but, we're almost fully vaccinated, and we've got the Delta variant, and yet we're still going to fully reopen apparently in 10 days or 2 weeks or whatever it is, right? So doesn't seem like the hospitalizations are really freaking out people too much right now. Something to probably use as a bit of an indicator on that kind of risk of further lockdowns in Europe and the derailing of that reopening is probably if you keep an eye on SXTP, right, which is this index, travel and leisure hospitality index, right? So if you compare what that's doing relative to the Euro stocks, it had a bit of a sell-off, it's had a bit of a bounce, but it's still underperforming, recently versus the Euro stocks. So if that starts to diverge lower relative to Euro stocks, like not doing much or rallying, then that's telling you, that risk of kind of on the reopening is kind of increasing, basically. Okay. And then, probably the last interesting thing on equity to talk about is China. So China, obviously China equities have been struggling for a while, but they had some PMIs. They had the China service PMI data out recently, last week, and that was pretty shocking, right? So that was down the most since last February. And it was showing, growth slowdown in terms of new orders, employment contracting, and inflation pressure easing. Yeah. So put down to like a resurgence of COVID infections in the Guangdong province, if I said that right, cited as a potential driver. So you look at that, you compare on the right-hand side, that's got both the services and the manufacturing PMI. So you see that big drop in the gray line, and below 50 means we're in contraction again, basically. So it's barely above 50. And, I don't know if service is a lead indicator on manufacturing, but, it won't take much to get manufacturing back down below 50. So China, we saw China's credit impulse rollover already. That was one of the things we were worried about on the commodity sector. Now we're seeing, the PMIs come down and equity markets are struggling, right? You want to look at the Chinese equities, they're not looking bullish, right? So let me bring up China here. It's looking pretty weak, yeah? So China if China's a lead indicator, given that they came out of the pandemic first, and you know how much the world depends on China, especially if you look at Europe in terms of exporting to China. You've potentially got, if China's on the verge of contraction, then you've potentially got a global reflationary wave looks to be reversing if China's any kind of indicator, basically, right? So I think that's the potential canary in the coal mine that everyone needs to keep an eye on. Okay. All right, so that's kind of it on equities. Bit of doom and gloom, really, to be honest, even though we're making all-time highs. But, people often get puffed into complacency when that's happening. So you need to be looking under the hood and looking under the surface to see. And really, the only thing that's rallying is tech stocks in the US, right? Outside of that, there's a lot of caution, I would say. Yeah. What's coming up this week? We've got the US, obviously we've got FOMC minutes on Wednesday. Are we going to get any new news out of that compared to what we got a couple of weeks ago? Unlikely, but who knows, right? Let's see what comes basically on that. That's probably going to be watched quite closely by the market. And then the only other sort of data point of any significance, in my opinion, is China's got inflation data out on Friday. But on the macro, I don't think there's too much that's going to massively move the market, right, in terms of data this week. If we then move over to FX, obviously the DXY has been, important. It had its break higher on the back of FOMC, etc., and the fact that the whole street was short dollars. That's been addressed to some extent, but arguably we could still push higher. If you look at that last leg up from sort of 91.5 to 92.75, we've pretty much touched that last retracement level of 92 and we bounced off there. So for now, the rally's intact. I was kind of using around that 91.80, 92 area as a bit of a stop in terms of dollar. But for now, yeah, I think dollar's still likely to go higher, right? If we look at a slightly longer term chart, daily chart here, we held those key levels down there at 89. I think the target to the upside, 93.5, is still in play. But you look at some of these momentum indicators that maybe they're signaling that actually the dollar's running out of momentum, right? So on that first rally there, we saw very strong momentum. That peaks out. We then make higher highs last week, but on very weak momentum. So there is a risk that the dollar's stalling here and could roll over, but I'd be using that 91.80, 92 area probably as a stop, right? In terms of thinking when that bounces over, basically. Flip side, obviously, of DXY is euro. Still looking for like 117 target on the euro. That's kind of consistent with a 93.5 on the DXY. And then the pound, on the pound, we're probably looking at 136 area as a target if we're going to get there, if the dollar's going to get to those upside levels. I think the only risk I would say on the pound is like on this reopening, right? If, Boris does actually deliver on the reopening on the 19th of July, then things should be all right. But if there's some delay there or a U-turn for whatever reason, then that could reflect quite badly on the pound, and the pound might have a downside sort of tail there on that reopening. So just something to be aware of if you're going to take any sterling positions around about that date, right? Or as we get closer to that date. Commodities, lots of action in commodities as usual, right? So oil, you had the big OPEC plus meeting recently. Well, it was last week, but it kind of went on till yesterday. They kind of hadn't managed to get any agreement. So we were looking for production cuts kicking in August on OPEC. They didn't agree, and then oil spiked yesterday, got as high as 77 in WTI, and now it's rolling over again. So I don't know if there's some news hitting the tape right now on OPEC, if the compromise has been reached or whatever. But basically, they need to come up with something, right? Because markets were undersupplied. There's an estimate that the markets are undersupplied by 2 million barrels a day, and demand growth is only expected to go up in the second half of the year, right? So, something needs to be done with regards to production increases. If it's not, then the tail risk to the upside goes up a lot on oil. People are talking about $100 targets again. And then the flip side of that is, if Saudi decide to go into a price war again like they did last year, then, you know, they might just unleash a load of supply and go against OPEC. Then what happens, right? Then you've got massive volatility to the downside. So all I would say is this kind of lack of reaching a compromise, if anything, it should probably just lead to higher volatility in oil. And if you look at intraday, what oil's doing, that's kind of what's happening at the moment, right? So we are starting to pick up in terms of intraday volatility in oil. I was thinking 78 was kind of your max target on the upside, but given what's happened with OPEC, I think all bets are off there. So I'm kind of staying away from oil because I don't think I've got any edge in calling what these guys are going to do. So that's oil. In terms of gold, bit lackluster it's been, but finally staging a bit of a rally. So we'd kind of held a little false break at that 1760. So got down to around 1750, and now it's finally bounced, popping its head above 1800 again. So there's a resistance zone between 1815 and 1830, 35. For me, that's kind of a key resistance. You've got Fibonacci levels, you've got moving averages, 50-day and 200-day, all kind of residing in that area. So if you're looking to play a short on gold, that's probably the area where it's starting to set up as a short. And until that area breaks, you're kind of all right with that position. So you probably place stops, you know, a bit above that, maybe 1840, 1850 kind of area. Yeah. For me, fundamentally, yeah, I don't think the setup's great for gold in the short term. Like longer term, I still think gold's fine. But in the short term, at the margin, if we're going to see a kind of move towards more tapering talk and things like that out of the Fed, if you think that's what we look like between now and say Jackson Hole, then it's probably not going to bode that great for gold, right? Also, gold's going to be impacted by the dollar. If you see the dollar as having more upside, again, that's going to weigh on gold most likely, right? There are times where gold and dollar sometimes move together, but at the moment, I think a spike higher in dollar probably won't be great for gold, right? Looking at the kind of recent price action, yeah. So that's gold. Copper. Bring up copper. Obviously, that's had a bounce as well. Had its correction down to around 405. Had a textbook bounce. It's kind of reaching that top end of if we call this a short-term downtrend resistance now. Kind of reached the top end of that, at risk of probably rolling over again. Given the sort of signals we're getting out of China, I wouldn't be in a rush to kind of tactically buy copper. I think if anything, tactically, copper's probably a short here. I mean, longer term, I love it. Don't get me wrong. It's in my long-term portfolio, but I'm certainly not owning it on a tactical perspective right now. Yeah. If we go back down towards 405 or even 385, that'd be a nice level to start picking up some longs, basically, right? And we're likely going to see some sort of momentum, some bullish momentum divergence if we were to head down there as well. So that would be a really good target to start putting some longer term entries in on copper if we were to get down there. But yeah, we're talking about a $0.50 move lower, which is, 12% lower. So it remains to be seen whether we're going to get that, but that's what I'm going to be keeping my eye on, right? And then we got the ags, right? The ags have been going nuts. So annoyingly, I keep my eye on the ags. I had some support levels down here at 1280 on soy, where maybe I would have dipped my toes in, but I was looking for kind of confirmation across, all commodities of reaching their sort of downside targets, which I didn't get. And then you had some news last week after weather-related disruptions, after some supply data came in, tighter than expectations. And these things just roofed it, right? We saw 10% rallies out of soy and corn, respectively. They're pulling back a little bit now. Wheat hasn't been quite as strong as those. So obviously the supply number's not quite as bad for things like wheat. But, these ags are super volatile, right? So, within the whole commodity complex, sure, as part of an allocation, they fit in, but I do see them as the volatile side of the spectrum. And for me, the fundamentals in things like these grains can swing about based on weather and things like that quite aggressively, whereas the fundamental long-term outlook for things like copper are much more stable. So I'd be more comfortable owning those in my long-term portfolio. So full disclosure, in my long-term portfolio, I don't have any ags, but I do have a ton of metals, basically. All right, I've got some tin, I've got some copper, I've got some nickel. And those are things that I'm happy to keep in there for a long time. Thanks for watching, guys. If you like this content, please subscribe to our channel, give the video a thumbs up, and hit the notification bell so you don't miss out on future videos. I'd also encourage you to sign up for a free trial to our live and interactive Macro Insight Zoom call. As part of our trading community, as well as the call, you'll also get access to our Telegram chat and our weekly market reports. To find out more, you can also connect with us on the socials. All the links are at our website, www.options-insight.com. Thanks.